2020 has been an absolute history book year for the stock market as we hit fresh all-time highs in February, and then we experienced one of the most violent stock market sell-offs in history in March, and then just a few short months later, we rallied all the way back, recovered all of the losses, and printed new all-time highs. Investors have been riding the asset price wave higher as the US government stepped in with massive amounts of monetary support and even signaled that they would do anything to get us through this. As I'm recording this video, it is the end of September in 2020, and the end of September means that we are in the end of the third quarter, or Q3 2020. Now at the end of each quarter, it's a notable time to pay attention to the headlines because you may start seeing headlines that talk about quarterly rebalancing. A recent article in Bloomberg quoted JP Morgan stating that they believe about $200 billion may be flowing out of stocks at the end of the third quarter, which is between now and the end of September. Specifically, JP Morgan said that pension and sovereign wealth funds are set to offload about $200 billion of equities as they rebalance their portfolios, posing a risk for global shares, according to JP Morgan Chase & Company. In the context of the global stock market, which is valued at tens of trillions of dollars, $200 billion is a drop in the water. But nonetheless, quarterly rebalancing can be a contributing factor to stock price volatility at the end of every single quarter. But what exactly is quarterly rebalancing and how exactly does it work? As mentioned in the Bloomberg article, institutions tend to adjust portfolios each quarter to maintain their target asset allocation. A gauge of global stocks has climbed about 10% since the end of June, exceeding returns from fixed income and pointing to the need for some funds to adjust their investment mix back to preferred limits. So what does this mean? Let's say I buy $100,000 worth of stocks and $100,000 worth of bonds. So therefore my portfolio value is $200,000, but I have a 50-50 split between stocks and bonds. Now let's say, as this article described, stocks increased by 10% over the quarter and bonds increased by 3%. What does this mean for my portfolio? Well, my stock position increased by 10%, therefore achieving a value of $110,000. But my bond position increased by 3%, achieving a value of $103,000. So now my portfolio is worth $213,000, $110,000 in stocks and $103,000 in bonds. Now, as you can see here, the weighting is no longer 50-50. Because the stocks outperform bonds over the same period, primarily the previous quarter, that means that the weighting of the stocks in the portfolio has actually grown larger than 50%. And with a portfolio worth $213,000, if I want to rebalance this to 50-50, that means I need $106,500 in stocks and bonds. So what do I do in this scenario? Well, to rebalance this portfolio, I will need to sell stocks and buy more bonds with the funds that I raise from selling the stocks. And to do this, I will simply sell $3,500 worth of stocks, and I will use that $3,500 in cash to purchase $3,500 worth of bonds. Now this will bring my weighting to 50-50 because I'll have $106,500 in stocks and bonds. And so every single quarter, as this quarterly rebalancing happens, it's going to be a drag on the outperforming asset of the previous quarter, and it will be a boost in the underperforming asset's performance. The second reason that we could be seeing some volatility in the stock market right now is, of course, that we have a presidential election coming up on November 3rd of 2020. Specifically, the tax policies for each administration could have significant implications for stock market valuations and incentives to invest in stocks altogether. A Biden victory could spell trouble for the stock market because part of his plan is to increase corporate taxes and to also increase long-term capital gains taxes, for wealthy individuals at least. Biden's proposed corporate tax increase is from the current rate of 21% up to 28%. which is quite a significant jump. And basically, if corporations are paying a higher level of taxes, that means less of that money hits their bottom line or net income. And because of that, the companies will be less profitable overall. And if they're less profitable, then that will reduce their stock price valuations. I mean, at least in theory, because I know that we can all think of a few companies out there that have seen dramatic stock price increases without having any resemblance of a business whatsoever. Aside from corporate tax increases, Biden also is proposing a long-term capital gains tax increase for wealthy individuals. Now, the long-term capital gains tax is the tax that you pay on any profits you make from selling an asset that you held for more than 1 year. So if you buy a stock and you hold it for longer than 1 year, and you later sell that stock for a profit, then you are going to pay what is called a long-term capital gains tax. According to an article in the Wall Street Journal, the top capital gains rate would nearly double under Mr. Biden to 39.6%. That's quite a steep increase. That rate would apply only to households with income exceeding $1 million, which account for the bulk of capital gains income. So this is not an increase for every single person. This is just a steep long-term capital gains increase for people earning over $1 million. Now, I personally don't feel that the increase in the long-term capital gains rate is going to deter investors from investing in stocks altogether, but it does significantly increase the cost of doing business for super wealthy individuals. Time will tell exactly who wins the election and what they do with the policies, but regardless, the policies of each administration are different and will therefore have an impact on the valuation of stocks. Finally, a fresh surge in coronavirus cases around the world has investors much more unsettled than they were a couple weeks ago. And obviously, this is because if investors are fearing lockdowns in the future like we experienced earlier this year, then obviously that is going to stop all economic activity in its tracks, and that is not going to be a good thing for anybody. And so the themes of everything that I've discussed thus far have been uncertainty. The stock market does not like uncertainty, and we are still in a very uncertain environment, and we are in uncharted territories because we've never experienced this situation right now that we're experiencing. With more uncertainty comes more stock market volatility. So as investors, we need to be psychologically prepared for the ebbs and flows to come. Now, the most important thing is to keep a long-term mindset. So in 10 years from now, are you going to regret selling your stocks right now just because they're dipping down a little bit? Or will you regret not buying more because in 10 years from now, it seemed like this was a no-brainer buying opportunity? Personally, I like to have a long-term focus, and since I'm only 27 years old and I have a very long-term investment time frame, I basically have a buy-only mentality. And this means that every single month when I get paid and I have cash left over after paying all my expenses, I am investing. I am not trying to actively time the tops and bottoms or the ebbs and flows in individual stocks or the overall market. I am just continuously purchasing more and more. And sometimes I'll purchase right at the top, and then right after I invest my new money, the market may fall. But then maybe the next month, the market is much lower, in which case I'll be able to purchase a larger quantity of shares for the same amount of money, and therefore bringing my average costs lower. And the goal is to, over time, build a significant investment base that can compound over a multi-decade period. So that's how I'm thinking about investing right now. Now, if the stock market does come crashing down like a house of cards, what should you do from an investment perspective? Well, here are my thoughts. Priority number one is don't invest at all in the stock market if you don't have enough money saved up and you cannot potentially weather the storm of more economic lockdowns and unemployment. The most important thing is being able to cover your living expenses for you and your family if you have one. And if you can't cover this first base, then investing in the stock market should not even be a consideration. But if you are in a good position and you have emergency savings and you're good to go, you're ready to invest your extra cash flow in the stock market, here are some things to consider. I think the most important thing is to keep your eye on the Federal Reserve. Given the vast amount of intervention that we saw from the Federal Reserve earlier this year in March and April, and the subsequent reaction in the stock market, I think any investor right now needs to be keeping a very close eye on the Federal Reserve's statements and actions. And that's because their statements and actions literally canceled the stock market crash in March of this year. And not only did it cancel one of the most violent sell-offs in stock market history, it also fueled an equally historic market rally to fresh all-time highs just a few months later. The Federal Reserve recently held meetings, and they just stated that their plan is to keep interest rates near zero through 2023. And that's a huge deal in the investing world. And basically what that means is that borrowing money will effectively be free for the next 3 years, which is a significantly important consideration when you are looking at investing. And that's for a number of reasons, which we will cover right now. First and foremost, when interest rates are ultra low as they are now, investors are encouraged, or nudged, I should say, into investing in riskier assets such as stocks. And that's because when interest rates are ultra low, there's virtually no return to be made for investing in risk-free assets or savings accounts. For example, in a Wealthfront high-yield cash account, I can currently get 0.35% on my money on an annual basis. Let's go. Now, if you want to get crazy, you can invest in a 30-year US Treasury bond, and you can earn 1.4% on an annual basis. But there is something that is super important to consider when we look at these rates of return, and that is that they are actually negative. There are two versions of returns that you should be familiar with. The first is the nominal rate of return, and the second is the real rate of return. The nominal rate of return is simply the figure that is stated. So when we look at this 30-year Treasury bond, the nominal return is 1.4%. And in that Wealthfront high yield cash account, the nominal return is 0.35%, or 35 basis points. But the real return is the nominal return less inflation. And so if inflation is 1% and this Wealthfront high yield cash account is earning 0.35%, then that means the real return on your money, if you put your money there, is actually a loss of 65 basis points, meaning you have a negative return of 0.65%. And that means if I put my money in this Wealthfront high yield cash account, then I will actually lose money. Well, not exactly money, but purchasing power, which is the only thing that matters. If I earn 0.35% on my money in a year, but the prices of goods and services go up by 1%, meaning inflation is 1%, then I have actually lost purchasing power because my money in 1 year cannot go as far as it can go right now. Understanding this is critically important right now, especially when we are considering investments to make, because when the Federal Reserve came out and they said we are keeping interest rates at near 0% through 2023, they also said that they are going to allow inflation to potentially run higher than their typical 2% target. So they are saying that if inflation gets to 2.5% or 3%, then they would be okay with that. And that's because in the past, they have had a 2% inflation target and they have rarely hit that mark. And that's because it's not them controlling inflation, it's the consumer spending and the aggregate spending in the country that causes inflation. In recent history, the Federal Reserve has had an annual 2% inflation target, which means they would like to see the prices of goods and services increase by 2% per year, as measured by their preferred inflation measurement, the Personal Consumption Expenditure Price Index. And why this matters in the context of investing is that if you are an investor and you are considering places to put your money, you essentially need to look for things that can potentially earn you more than 2 to 3% on an annual basis. And as we've already discussed, the Wealthfront high yield cash account is not going to cut it, and the 30-year Treasury bond is also not going to cut it in terms of real returns. And that's a big reason why investors right now are encouraged to invest in riskier assets, because these lower risk assets aren't earning enough money to actually produce real returns, meaning they aren't earning enough money to actually preserve or increase the purchasing power of investments over time. And aside from investing at all, by saying that they're going to allow inflation to potentially run higher than their 2% target means that they are trying to encourage consumer spending. Because as I described, inflation can also be interpreted as the loss of purchasing power over time. And since the Federal Reserve just came out and said that they are going to allow the US dollar's purchasing power to depreciate at a higher than normal rate, then that means people are incentivized to not save money. They are incentivized to spend their money because they can afford more things right now than they could afford in the future, assuming that we do see higher levels of inflation. And encouraging consumer spending is really what the Federal Reserve is trying to do with their policies. Now, this leads us into point number 2 that I want to discuss as it relates to investing in the markets right now. And that is, for my personal opinion, don't hold cash. If you believe the aggressive monetary stimulus and the unprecedented money printing could potentially lead to excessive levels of inflation in the future, then actually holding cash is a risky position. Now, this may sound like nonsense because I know you are familiar with the phrase cash is king. And typically that's true, but cash is king only when there are no apparent risks of aggressive currency devaluation. Now, cash is only king when the cash that you are holding has a very high likelihood of preserving its purchasing power over time. And in that environment, cash is the safest position that you can have. And to be clear, I am not saying that high inflation is inevitable. All I'm saying is that if you read a lot of articles and you do some research on this topic, there are many very smart people who are worried about an aggressive devaluation in the US dollar, meaning that if we do see these higher levels of inflation, then cash is going to be a position that is going to lose a lot of purchasing power. Now, there are a couple more implications of ultra low interest rates for the next 3 years. The first one being that accessing funding is going to be much cheaper over the next 3 years than it should be in a normal higher interest rate environment. And if corporations have cheaper access to funding, then that means they will be able to fuel further growth much easier or at a lower cost than they could with a higher interest rate environment. Additionally, ultra low interest rate environments means that the valuations of companies' future cash flows is actually going to be worth more compared to the same cash flows with a higher interest rate or discount rate, which is commonly used in cash flow based valuation models that are used to value stock prices. So since the lower interest rate is actually going to lead to a higher value of future cash flows in today's value, that is going to result in a higher stock price valuation in these models. I can't tell you exactly what to do with your investments because what you should do is completely different than what I want to do or should do, because it really depends on where you are in life, how old you are, and your risk tolerance overall. So if you're an older investor and you have retirement coming in the next few years, then my investment strategy is probably not going to be good for you because I'm 27, I have a very long-term investment time frame, and since I have a lot of future earnings to look forward to, then I can actually afford to take higher risks right now, because if some of my investments go bust, then I can recoup those losses from my income in the future. But when you are retired, since you don't have income from a job, then recovering losses from your investments is much more difficult, and you are relying solely on the recovery of your investments to get back those funds. Personally, I am buying Bitcoin and stocks every single month. I love Bitcoin as a long-term play because it is an asymmetric return asset, meaning that it's either going to be worth nothing or it's going to be worth significantly more than it is worth right now. And for that reason, I am putting a fairly large portion of my investments into Bitcoin because I think this is the perfect environment for a Bitcoin bull case with all the government intervention that is going on right now. Some of my favorite individual stocks to invest in right now are also very high risk, and they're mostly tech stocks. And those stocks are Tesla, Nvidia, and Square, just to name a few. But because of all the uncertainty right now with individual companies, I also am a big fan of investing in index funds, such as VOO, which is one of the S&P 500 index ETFs, or QQQ, which is the NASDAQ 100 ETF, which is a tech-based index, or something a little more exotic like ARK Invest's Innovation ETF, which is ARKK. And they invest solely in companies that have potentially disruptive technologies that could change the way the world works in the coming years. Now, that's a higher risk index fund because they are making more predictive bets, and the annual expense ratio, or the fee that you pay on your investments every single year, is currently at about 75 basis points or 0.75%. Now, that's a lot more expensive when you compare it to something like VOO, which has an expense ratio or annual fee of just a few basis points. So personally, I feel that if you are a younger investor or you have a higher risk tolerance and a long-term investment time frame, then I think it is a good idea to research some individual companies that you think are at the forefront of new technologies that could be more and more prevalent in the future. And more specifically, companies that align with where we are potentially going in the future. So basically, autonomous driving, fully self-driving vehicles. We have things like gaming and the AI spaces, which I'm a big fan of. Those are some things to keep an eye on, and research individual companies within those spaces because those could be extremely high growth spaces in the next 5 to 10 years. If you are an older investor with naturally a much shorter investment time frame and a much lower risk tolerance, then of course it doesn't make sense to have a ton of exposure to the stock market. But I still think it is a good idea to have exposure with a very small portion of your overall investment portfolio. But typically, as you get older and as you get closer to retirement, the investment weighting shifts more into bonds, which have much lower risk and they have lower returns also. But the name of the game, once you have a large investment portfolio and you are older with a lower risk tolerance, is wealth preservation. Now, I'm not going to claim to be an expert on investing when you are nearing retirement, so it would be best if you talk to a professional. But personally, as a much younger investor with a long-term investment time frame, I spend a lot of time focusing on high risk, high reward investments, but obviously that's not going to be the best approach for everybody. All right, so we have talked about so much in this video, and thank you so much if you are still with me. I really hope that you gathered a lot of interesting information from this video and you have some things that you want to look into on your own. All right, if you enjoyed your time here today, please give this video a like. I would really appreciate it, and consider subscribing. Also, leave me a comment down below and let me know where you think the stock market is headed over the next few years. And also what you think will be the best performing asset classes over the next 5 to 10 years. I think it would be super interesting to gather opinions from a lot of different people from a lot of different backgrounds. So be sure to leave that comment down below. My name is Chris Butler, and remember, fortune favors the prepared mind.